how should a firm think about determining the right outputs, I guess? And I agree that a lot of firms seem to simply look at deals done and dollars deployed. But do you have a feeling for what the right outputs are the ones to focus on? And how do you think about that different factors about a firm and investment strategy, like what might influence the outputs that they choose to focus on?
Yeah, it's a great question, right? And I think a lot of us will naturally jump to just saying, oh, well, there's one way to do it, right? But I don't know if that's right. So I think we got to take the step back, which is to look at like back we were talking about you get what you measure, and this to me it really boils down to just being an alignment between the goals and strategies of the firm and the goals and strategies of the sourcing organization, right? Like there has to be alignment there, and at least in my experience, like you look at most private equity firms, right? Like you've got some sort of LP base, and like most firms are measured on some sort of combination of IRR, MOIC, or some combination of those, and perhaps they've got a hurdle rate, and there's some sort of escalator, even maybe on carry based upon performance of the fund as a whole. We know that. We also know that the number one job of a private equity firm, like we talked about at the beginning of the call, is like, look, obviously invest capital, like grow that capital as much as possible, generate the returns, right? And we've spoken about this before when you talk about like where do returns come from, like the formula for these top tier funds, like there's three things, right? Source great deals for a good price, plug in a great operator to drive the metrics that you need, and then attract the buyers that are going to pay the highest price. And like oftentimes that's the strategics, right? And so sourcing actually plays into all three of these. Like it in terms of like actually finding operators and actually finding buyers, like you're in the market, and so you're doing all those things too. But like obviously the number one thing here, the primary job, is to deploy capital, right? Like and not just deploy any capital, but deploy capital in businesses that have the potential to generate these returns, independent of whether or not you get the right operator, and independent of whether or not you find the right buyer. Like your job first and foremost is like, if we had it, even if we had a shitty operator, and even if we had we didn't find good buyers on the exit, like we need to start with like, let's have a good business, right? Good business to invest in. And how do we make sure we've got a great starting point? For most PE firms, right? Like again, what you're going to measure, it's got to be tied to the ability to generate those returns. It's got to be tied to the ability to deploy capital. But if your strategy is different, like there might be different things that you want to measure for your firm as a whole and for your sourcing team in particular, right? Because like if you've got, for instance, a buy and build strategy, right? Where you're like, hey, look, yeah, like we're going to buy great businesses, sure, but like our strategy overall here is like we're going to go, put a bunch of add-ons on top of this thing, bundle them together and sell it to the next buyer, right? So like it's a little bit more of a volume and a velocity play. And so if that's the case, like you might want to just measure more than anything else your sourcing team's performance on add-on volume. Sure, maybe part of it is deployment in the platforms, because we got to get the platform in order to do the add-on. But like if our strategy is really around doing add-ons, I need to measure add-on volume and velocity, right? Maybe it's the size of add-ons, maybe it's just the total number of add-ons. Depends on the firm. But if you're maybe a traditional LBO, and you're focused on, I don't know, it doesn't have to be industrials, but say you're focused on industrials, maybe you're doing fewer deals per year. Like I was talking to a firm the other day, and they're like, yeah, like to us, it's about doing 2 or 3 deals per year, right? It's not the higher volume sort of thing. Or it could even be that you're operating more like an SPV, and you just like, hey, look, we just, we need one really good deal, right? And so it might be that like for you, it's more about finding that one great deal per year, or those 2 or 3 great deals per year. And so you might just want to measure, hey, did we get one really good deal done this year? Right. And like, did we put enough LOIs out there in order to get that one good deal? And so for you, that might be more the way you want to measure it. But perhaps you're maybe a high growth, high volume growth equity firm, right? And so for you, like, okay, it's about us aggressively, deploying capital, like where we're trying to raise our next fund in the next 2 or 3 years. And like for that case, then to me, like capital deployment is probably your friend, right? Because like you need to get dollars to work, baby. We got to put them out there, and we need to do. It's not just number of deals we do per year, and it's not 1 or 2 deals per year, but we need to do 10 or 15 deals per year. Like I don't know, right? Whatever it is.